Welcome to the Compass series of conversations with leaders charting the course in impact investing, and thank you for joining us. I'm Ben Thornley, and we're excited at Tideline, ahead of New York Climate Week, to be focused today on the opportunities to deliver climate-related impact through public markets. Survey data from the Global Impact Investing Network indicates that about 2/3 of impact assets are directed to private markets, which resembles what we've observed in the effort to drive climate impact. To be sure, the impact investing headlines have been dominated in recent years by the launch of a string of huge private equity and infrastructure funds focused on climate. These are names like Brookfield and TPG that now dominate the rankings of the largest impact managers. But for asset owners and allocators, private markets are just a part of a balanced portfolio, and usually a smaller part. In order to deliver the volume of capital needed to make a dent in climate change, estimated to be at least $3 trillion per year, we need public markets to play the leading role. So we are thrilled today to be joined by four leaders committed to broadening the fight against climate change through public markets. We will reserve time for viewer questions toward the end of our panel, so please do use the Q&A function in Zoom. Heather Beattie is the founder and CEO of Scope 4 Capital, an asset management firm specializing in investing in companies that produce and scale climate solutions. Prior to launching Scope 4, Heather held leadership positions at a number of global financial institutions, including creating and co-chairing the first climate council at First Eagle Investment Management. Welcome, Heather. Jorge Colmenares is a director in clean energy finance at Citi, with over 25 years of energy and banking experience, including in project finance, acquisition finance, structured finance, and corporate finance. Among his current responsibilities, Jorge is focused on new IRA tax credit monetization transactions within the clean energy sector, with flow-on effects in public markets. Brett Hoff is the managing partner and chief investment officer at Congruence Capital, an innovative new fund targeting middle market decarbonization. Prior to Congruence, Brett was an investment professional at Centerline Capital Management, Archer Capital, Macquarie Group, and Western Asset Management. Tetiana Kisletsina is a hedge fund and sustainable investment officer for UBS Hedge Fund Solutions. Tetiana is responsible for due diligence of fundamental relative value, event-driven and multi-strategy hedge funds. She also leads work on UBS's ESG assessment framework across hedge fund strategies and helps manage dedicated hedge fund portfolios that incorporate sustainable investment considerations. Thank you all for joining us. Heather, turning to you first, and to help set the stage, why has the focus been on private markets when it comes to climate transition? And why should investors broaden their horizons to listed equities in the case of Scope 4?
Yeah, that's a great question. So, private markets, I think, are still a great way to get exposure to climate solutions. And just in talking with allocators, it's often either on the climate tech side, if you're thinking about VC, it could be in project finance or even blended finance, which is really important for a lot of emerging market countries. So it just depends on how you're allocating. And so I think that oftentimes institutions and investors in general really think about these very specific opportunities in private markets when they're thinking about the energy transition opportunity overall. But I do believe that we should be investing across asset classes, so not just in private markets or in public equities, because when we think about decarbonization, it's not really a one-size-fits-all risk and reward. If you think kind of along the continuum, philanthropy, of course, is also really important. If you think about peatland rewetting, for example, or grassland protection, those are two climate solutions that are really important from a decarbonization standpoint that we can't really monetize. When we think about things like kelp and the ocean economy, that's really still in its nascent stages, and so it's appropriate for VC. But if you want to think about scale and distribution, I think that's really where public markets come in. And it's a great way for an investor who wants to have exposure to this theme to get just a view of the landscape overall. So a lot of people aren't aware that 2/3 of the technology that we need to solve this problem we already have. And so you have these huge companies that are investing, $8 billion, for example, in R&D, or have these huge multinational conglomerates that are focused on this problem. And so it really, I think, lends a hand to the ability to actually scale what it is that we need to do.
And where does Scope 4 fit into that, Heather? Can you tell us a little bit about what Scope 4 is doing?
The firm.
Yes.
Oftentimes people ask, what is scope 4? So for those of you who aren't aware, scope 1, 2, and 3 are the ways that you can categorize your emissions internally. And then, so first you want to create a baseline, and then you need to verify what that is, and then work towards reducing them. But scope 4, in my opinion, is kind of the next phase. Basically what it is and how we define it is anything that's reducing or avoiding emissions. And the ways that we invest in these companies is it's through their revenues that they're actually scaling. So, for example, grid electrification and fixing the grid is a huge part of solving the climate crisis. And companies like ABB have over 90% of their revenues dedicated to that today. And so we would categorize the revenues, if you will, as a scope 4, where the growth of these companies based on their business models are actually helping solve the climate crisis because they're reducing and avoiding emissions. And you can look at that across a variety of different themes. Of course, renewable energy is a huge part of it, but it's also in areas like the built environment or buildings in general. Actually, a huge part of emissions are coming from buildings. And so you can implement things like smart glass or building automation systems or smart thermostats to help reduce it. And so we can kind of go across each one of the themes. I'll just mention a few more here, and obviously we can go into detail as much as you want, but nature-based solutions can be found in areas like agriculture and sustainable forestry, and then also climate tech and the circular economy. So waste is a huge piece of it as well.
Got it. Thanks, Heather. Jorge, turning to you, a similar question. Are there opportunities right now for investors to help create climate impact in public fixed income, or at least what are some of the range of opportunities? And how is the goal of creating climate impact being baked into public fixed income products?
No, absolutely. So I think we have to start, obviously, as you mentioned in your intro, Ben, the role of public markets that's truly to overtake to be a driving force. So specifically in fixed income, obviously a lot of private activity, right? But the most important thing is that we have to kind of like raise the demand. This has to be driven from the demand side. And when I say demand side is basically those asset managers that you talked about, Ben, they have to identify really their benefit in these investments. So when you look at that, then obviously the first thing that comes to mind is like the so-called green premium. Are investors gonna capitalize on that green premium? I kind of don't like the greenium kind of label of it, but green premium sounds really nice. And that's obviously what asset managers want to achieve. But if you think about it, then in order to achieve that green premium, you need to strengthen the issuance side, right? So everything goes back to the issuer. So you need to de-risk the issuers. And in their issuance of their instruments, they have to be de-risk. And how do you achieve that? And that's where I feel very excited, because obviously something very kind of momentous happened 2 years ago with the passing of the Inflation Reduction Act. But let's just throw that label out the window, right? It is the climate legislation. It's like the biggest climate legislation that came about. And now we see issuers all across going to benefit from this investment, from renewable tax credits or the IRA tax credits. And the market has just simply ballooned, right? Just to take a little bit of moment to talk about that, because I think it's instrumental. Once you strengthen the issuer or the supply side, then you can really bring public markets into the equation. So the Inflation Reduction Act with all this tax credits, have all of the sudden, the the legislation came about 369. You talk about trillions of investment to needed to achieve climate transition. But you start with the government providing $369 billion of tax credits, of motivation or incentive. Actually, the Congressional Budget Office earlier this year said that that number was grossly underestimated. The letter of the law said 369 billion. People like other folks, my institution and other institutions, are estimated that number is up in the 700 billion, like almost even close to $1 trillion. And if you think about that, then the issuers are de-risking their profile. Then all of a sudden, with that de-risk, the yields come down in those products, in those fixed income products, and then our friends on the asset and the asset managers all of a sudden see that green premium coming about. So specifically to your question is, yes, there are tremendous opportunities right now. Obviously, we can go in detail how to really kind of determine what are the specifics of these opportunities later on, but suffice to say, we're really, really excited about what's coming and the future of this in the market.
Well, that's exciting. Well, thank you, Jorge. I think, and as you said, we'll come back to dig into some of those products and their characteristics. Brett, coming back to public equities and to Heather's earlier comments about the historic focus on private markets, I think one of the challenges many of our clients and audience have had as impact investors has been to find opportunities in public markets that are sufficiently intentional, with the opportunity for what we call contribution, or the opportunity to influence investees, and the ability to measure impact. So what's Congruence's strategy, and how do you address those challenges of intentionality, contribution, and measurement?
Yeah, great question. So at Congruence, we're investing in undervalued small cap industrial businesses that'll thrive in a vision of the future I think everyone here shares, and then helping them identify opportunities to make their businesses both more sustainable and create shareholder value. So two of our partners are pioneers in the sustainability consulting field, and they provide their expertise to our portfolio company management teams to help them identify win-win solutions that have a positive environmental or social impact and a positive financial impact. So the name of our fund, Congruence, is a reference to this concept that sustainability improvements and shareholder value creation are actually congruent objectives. So, many of the solutions we're recommending are actually new technologies that the people in this webinar have helped create through their venture capital investing. But as a lot of you know, even if a VC-backed company has a better, cheaper, faster, and more sustainable solution, a lack of sales resources or corporate inertia can mean a slow adoption curve. I think some of the headline-grabbing activist public markets impact strategies have sought to get management teams to commit to things like net zero targets, but they don't offer any solutions on how to actually meet those goals. We think that approach is akin to telling your kid they better get into Harvard or you'll disown them, and then never bothering to help them with any of their homework. When a company helps, we think when a change helps a company generate more revenue or reduce costs, those changes are sticky and they can scale. We found that most CEOs want to create value for their shareholders because they're personally incentivized to do so. So we always start with the business case for our recommendations and what's in it for them, then explain the benefits of the sustainability impacts. So to give you an example, one of the companies we're investing in makes large diameter steel pipe for water transmission infrastructure and precast concrete products. We like the thematic alignment with growth from water infrastructure investments. And I think while everyone here can appreciate why that's a powerful investment theme, the company itself is still very early in their own sustainability journey. So in collaboration with management, we put together a comprehensive sustainability improvement plan comprised of 12 impact initiatives. And to give you an example of one of those impact initiatives, There's a technology that takes captured CO2 and injects it into concrete to improve durability and reduce cement consumption. This has a direct cost savings from using less cement. The company generates carbon credits, which they can monetize. It reduces the carbon intensity of their precast concrete products, and it allows the company to market to customers who want more sustainable building products. We think solutions like that that make the company money and reduce emissions are the kinds of things we should be targeting. So to summarize, I think while we operate in public markets, it's clear from the engagement process, I outlined in the example I just gave, there's intentionality, materiality, and measurability to the impact we're targeting, which are all the hallmarks investors expect in other forms of impact investing. And the way we are applying impact to our investment process helps us hunt for idiosyncratic alpha, which is the holy grail of public market investing. So we don't expect our investors to accept lower risk-adjusted returns because we're a public markets impact fund. Our goal is to be the best performing hedge fund in their portfolio, period.
Well, that's exciting, Brett, and I think a really novel brown to green type of strategy that I think will be sort of new for many of our viewers, and look forward to hearing more about congruence in our next round of questions. But thank you for that. Tatiana, at UBS, you have visibility across the market and across various fund strategies. Are there many managers doing what Heather and Brett have shared with us that they're doing? And what do you look for in managers like Scope 4 and like Congruence to know from UBS's perspective that what the manager is doing is real, authentic, and there's a high likelihood they'll actually be generating the climate impact they're promising?
Sure. Thanks, Ben. I would say overall, UBS has more than 20 years experience in sustainable investments, right? And that means cultivating basically a range of strategies that are aimed at helping driving positive change beyond just financial returns. And when I talk about our SI capabilities, they cover both traditional and alternative, active and passive investments. They span across asset classes. But as you mentioned in your introduction, my focus is exclusively on alternative investments, specifically hedge funds. So my answer is probably going to be biased towards that area. So for us as a hedge fund allocator, two contexts are important. First, the underlying manager level, and then the portfolio level. And by portfolio, I mean the one consisting of a number of hedge funds. So first, at the hedge fund manager level, an important part of our investment process is building out peer groups. So to your question about managers out there and their approaches, we are always focused on the accuracy and reliability of our benchmarking and comparison efforts. Our sustainable peer groups are no exception. And the first step for us here is to understand what a manager actually does, to what extent their investment process is shaped and impacted by climate-related considerations, and who their closest peers are. And what we've learned empirically is that as we move away from that very broad domain of investments in general, as we focus narrowly on hedge funds and even deeper, let's say, on the equity long short strategy specifically, investors still have to deal with a wide variety of interpretation and approaches to integrating climate in portfolio management. And some of those approaches may or may not include engagement with the investee companies, as was alluded to during the panel already. Some may be focused on the leaders in this space, others on enablers, winners or losers of climate transition. Some may have a bias towards a certain sector, for example, energy or utilities. Others may have a broader focus. So I'm afraid there's no straightforward answer to that question, but I think what's really important is that an investor who's focused on the potential climate impact of their portfolio has to establish essentially if the hedge fund manager in question aims for the level of impact or enablement of climate transition that an investor is interested in, and how the manager gets there. Because arguably, one could have a portfolio of Magnificent Seven stocks, which will have a lower climate risk versus a portfolio of certain industrial stocks. But the question is, is that what an investor really is trying to achieve? And that then becomes very much of an investor or a client-driven answer. Now, as we move from that manager level to the level of customized portfolios of hedge funds, we tend to approach that by developing a set of requirements. And again, something we've realized, there's very rarely kind of a one size fits all for clients, which is why we can consider a variety of approaches. They may include exclusions, sector, geography, or other screening, SI integration with related objective setting, etc. So essentially, the purpose of the exercise would be to understand those client or regulatory driven restrictions and assess if with all of them in place, we can still construct a viable hedge fund portfolio. So in practice, we tend to work with some sort of exclusions or certain level of allocations to sustainable or sustainability-oriented investments, for example, with climate-related objectives that would align with client or regulatory-driven requirements. And last thing I'll mention here is that monitoring and progress tracking obviously are very important parts of our post-investment process, especially as policies evolve and industry participants become more informed and experienced. So here we would aim to assess if the managers continue to meet our initial requirements that we kind of formalize via a set of custom developed data points, and the trajectory of the manager's approaches is also important here.
Got it. And Tatiana, how deep is the market in your view for these types of opportunities for investors?
I think the market is out there. It's differentiated across various hedge fund strategies. I would say typically we would find more players in the equity long short space, specifically to a question about public market investing, right? Perhaps less players within the credit long short. However, this is not to say that other strategies are not represented. Environmental credits trading also has a peer group of its own with carbon credits and other types of trading. You may find quant equity managers that also integrate climate considerations to a certain extent in their processes, et cetera. So the peer group is certainly out there. Now, the question is, what sort of requirements are we working with that we have to kind of consider and then decide, can a portfolio be constructed, or is it going to consist of like one or two funds?
Got it. Got it. Great. Well, thanks, Tatiana, and look forward to coming back to that question of measurement and accountability here in a second. But Jorge, I'd like to come back to you. I think Tatiana described a little bit about the criteria for allocating capital, particularly within public equities, and wanted to ask you a similar question about the criteria that you look for and the capabilities you look for in public markets that would indicate to you that the borrower or the issuer of the debt is serious about climate impact and is in a good position to create the climate impact that they've promised.
No, great question, Ben, and it's pretty much that what Tatiana was talking about mirrors on the fixed income side, right? So what, to your question specifically, what are kind of asset managers looking at is that basically the issuer, and this is well established, they must have a framework in their issuance that they follow, that is well defined, that is certified to a certain level, in order to make sure that these are the targets that the asset managers are compliant with. It's like Tatiana was saying, it's not only at the time that you make the investment, that you buy the bonds, it's also post the investment period. You have to make sure that there is a monitoring and measurement. So that framework has to encompass all of that. It's kind of like a check the box kind of thing. I mean, the investors are not going to do it if the issuer doesn't have that framework well defined. Because think about it, our debt capital markets bankers here at Citi, right? What do they do? And in terms of what differentiates them from placing a bond or selling a bond to an investor, a regular corporate bond, versus selling a specific label bond, these are what they're called, a specific label, right? Whether it's in sustainability, whether it's a green, whether it's social impact, they're called a specific label. So when they go about to selling the bonds, they use the same criteria. These are corporate bonds. These are like specific label bonds. What is the attractiveness for a buyer, for an investor to invest in those bonds? And it has to do with what Tatiana was talking about. There has to be kind of a sustainability agenda that the investors have, they have to meet. But the only way that they're going to have to meet, they will be able to meet that criteria, it goes back to the framework on the issuer side. So here we find ourselves, and our bankers are having difficulties sometimes when the issuers are not strong enough. It goes back, you have to strengthen the issuer, right? When they're not strong enough, how to make sure that the asset managers, the investors are making sure that there's sustainability goals, their agenda, whatever requirements they need to meet are met. So that's very important from the get-go. Then the debt capital markets professionals will go and start looking for sleeves or kind of pockets of money where they can find and kind of place these bonds with. So that is not something that we're looking for, right? We don't want that opportunistic. We want the markets, the public markets, to become kind of widespread to get the scale that we need. It goes back, you have to strengthen the issuance side.
Got it. And I think one of the exciting things about what you've just described, Jorge, and what you said earlier about the Inflation Reduction Act is the possibility that we could really get to scale through public fixed income. I think a lot of the labeled products are definitely growing quickly, but feel a little more niche.
Right.
Whereas I think what you were describing sounds like a real opportunity to grow this market in important ways.
No, and I think, I mean, I think everybody in this audience would agree, like if we turn the clock a little bit back to 2020, there was tremendous growth, right, in this area. Everybody was like super excited about sustainability, impact investing, everything related to. Obviously, over the last 3 years, we have gone through a lot of stuff, right, including a pandemic and so on. But there is, unfortunately, there is a climate, just to be redundant in the use of the word, but there is a climate driven by politics, driven by whatever it is, right? There is somewhat of a polarization that some sides are saying, well, the funds and different investors, I don't want to go too much out on a limb in that direction because I'm being penalized otherwise. And that's something that has to be completely removed, right? So, I mean, I kudos to legislation like this and to keep things completely nonpartisan. I mean, we need this type of initiatives to go through in order to make sure that those frameworks, those requirements from a sustainability side, whether it's driven by legislation or regulatory, but at some point, like Brad and Heather they're working with this type of incredibly kind of avant-garde companies and very impactful companies that they become the norm, right? So this polarization starts to disappearing, and that boost and that momentum that we have 3 years ago comes back to the table, because that's exactly what you were talking about and what we're looking for, that the public markets really drive this. That's where the most effect we're going to have.
Got it. Thanks, Jorge. Heather, turning to you, a similar question. I think what you described was a strategy that seems to constrain the universe potentially. How do we get to scale in that market, and what is the potential for scale in that market? Like with unlimited capital, I mean, what's the end goal for Scope 4? And how does that capital impact the fortunes of the companies that you're invested into? I know that impact investors also would be interested to understand, how their capital will affect the trajectory for the companies that you're invested in.
Yeah, that's a good question. So let's approach it as like a two-part answer. I definitely think, we've already talked about how public companies have the size and financial flexibility to drive the mainstream adoption of climate mitigation. But I also think that, and I talk to a lot of investors, that there's this misperception that there are only a handful of companies, sometimes feel like under 100, right, that have revenues that are focused on decarbonization as a material part of their business model. And I think that's fair because we interface with MSCI all the time, and FactSet and a lot of these index providers, and they haven't yet come up with a full suite of indexes that I think reflect the alpha opportunity and the overall market. And so what we've done at Scope 4 is we actually developed first a framework, or what we call our climate taxonomy, to say, okay, here are the 6 segments that really represent emission reduction or emission reduction potential we talked about earlier. And then we mapped what we think are economically viable climate solutions, and also currently impactful, because that's really important, to a list of actually 3,000 global public companies. So we actually have a list of 3,000 companies, and they range in market cap, obviously from micro cap to large cap. I think that investors should begin to think in a way about climate as a bit of a subsector that has specific characteristics for growth. If you're kind of just very pure play and just focused on decarbonization, it definitely skews towards industrials, just to give you a sense. There are a ton of companies in the US and China, and also, as you would imagine, Europe, and some also in emerging markets, but less so pure play. So oftentimes you'll see kind of that brown to green revenue stream that Brett talked a little bit about. You'll also see less healthcare companies or financials or telecom as just an example of what you might see in that universe. And even real estate, we talked a little bit about the technologies that you can begin to implement to decarbonize, but in the public market space, there aren't huge companies that are just focused on like REITs that you could identify as decarbonizers. Another thing that I think is important, and also a misconception, is that these are all micro cap companies that don't have a ton of free cash flow and don't have a solid balance sheet. But we do in our portfolios really focus on that, so that companies aren't necessarily dependent on subsidies or on the macro environment or on the political environment to grow. So in terms of where I think the opportunity is, just from like an AUM perspective, I personally think the sky is the limit, that you can create global strategies. Our flagship strategy is global, but then a subset of strategies, even micro cap, and really just focused on the opportunity. And what that tends to create, in our opinion, is uncorrelated alpha, and also exposure to a thematic trend, kind of similar to what you would even see like reflective of AI, or the digitization of our economy, or the industrialization of our society. To me, the decarbonization of our economy is going to have widespread implications on how we're experiencing the world. So that's the first piece of the answer. And then just in terms of how is this affecting the companies, because I get that all the time, and please reach out to me, because we actually wrote a white paper on how public companies can have positive climate impact. And I do agree that engagement is really important, but I don't think that's the silver bullet, right? There are a lot of companies that don't want to change. You can engage with them in perpetuity, that are just going to, do a lot of head nodding and not really make change. Is all on the margin and in very incremental ways to 2050, right? So in terms of these companies, we think that a formidable stock performance can lower a company's cost of capital. So that's really important. It can increase its borrowing capacity. And we also think it can attract top tier talent. And so this also helps ease the path for innovation and market share expansion for some of these business lines that are focused on climate. And the other piece is technology. Technology really matters. I'm actually at the DROP conference right now. If any of you are familiar with it, it's in Malmo, Sweden, and it's focused almost exclusively on climate tech. But it's in private markets, and it's all very, early stage. And so I believe that the visibility of public markets makes it easier for these private companies to identify and replicate these business models that are working well. And Tesla obviously is a very controversial company to talk about these days, but it definitely paved the way for the EV infrastructure and supply chain in general. And now that's a proven business model that's out in the market, and you can make the case for that with a variety of other business models that are maybe not as front and center. And so to me, public companies and public markets in general do provide that.
Got it. Well, thanks, Heather. Super topical points about public markets generally and the benefits of directing more capital there for impact investors. So thank you for those comments. Tiana, I want to come back to you on the portfolio construction conversation that you were taking us toward, which is very important for allocators, and what it means to manage risk in this area and take a very diversified approach. So that's the first question. And then the second, and you alluded to this as well in your earlier comments, how can asset managers do the best job possible in public markets to measure their impact? And again, what are you looking for there? And what are you hoping that asset managers put a little bit more effort into in order to improve their measurement practices in public markets?
Sure, I think these are both great questions. So starting, with the first one, within hedge fund portfolios, what makes them stand out is really the range of instruments and strategies, including the shorting capabilities that aren't necessarily available when pursuing a long-only approach, for example. So that in itself can be quite an effective mechanism of achieving both portfolio diversification and climate-related objectives from both long and short sides, right? And another thing is, while hedge funds are often referred to as an asset class, I believe that a more nuanced approach has the right to exist here, as the underlying instruments used by hedge fund managers, such as various equity, credit instruments, derivatives, etc., they are all asset classes in and of themselves, right? Especially if you add the shorting capabilities to that list. So going a little bit back to our previous discussion about various investment approaches, that combined with the fact that client can be a consideration in other hedge fund strategies, not just in equity long short, but a number of credit, quant, non-corporate instrument oriented strategies like environmental credit trading, etc. These are all ways of addressing diversification and cross correlation within an allocator's portfolio. That sort of, I think, ties into your second question about measuring the impact and the room for improvement in that space, because certainly there is more work to be done around it. I see potentially three main drivers that could foster change in the hedge fund sector: regulators, data, and clients or investors, whatever you want to call them. Something that Jorge alluded to today. With the ongoing development and the growing demand for alignment across regional sustainability-oriented regulatory frameworks, should come the willingness and ability of hedge fund managers and public corporates to meet reasonable and consistent reporting requirements. And I really want to stress reasonable and consistent here. And that sort of ties into the data factor, as hopefully we'll see more interoperable and coherent reporting frameworks that make data available, transparent, easier to benchmark, that are more straightforward for investors to interpret and draw conclusions from. These should be coupled with consistent reporting provided by the underlying investee companies that managers can then meaningfully rely on and incorporate in their investment decision-making process, and then in their turn also present it to the investors in an aggregated portfolio level manner. Last but not least, certainly clients are a powerful and guiding force here, and in the solutions that we offer, I do think that their customized requirements will play an important role in shaping the industry. So again, seconding some of Jorge's points, it's a two-way street basically between the clients asking for more transparency on meaningful and material data and regulators providing those comprehensive, sensible frameworks to satisfy that demand, while also allowing allocators to construct viable investment portfolios.
Got it. Got it. Thanks, Tatiana. And definitely, I'm seeing measurement coming through as a big focus in the Q&A. So I think we'll come back to this question. And I think what we're seeing in the Q&A is some of the questions that I've been asking too, that often come up for impact investors who are trying to navigate public markets and ensure that there's clarity on the kind of impact that's being created and that it's measurable. So we'll definitely, I think, come back to that point. Brett, I did have one last question for you, and I think it relates again to how we get to scale here. You know, what you're doing is very specialized, obviously with smaller companies, quite a novel model. In fact, I think one of the questions that came through was whether you charge for the kind of support you're providing to companies. It obviously is that specific and that valuable to the companies that you are invested in. But what is the systemic change that it might be possible for Congruence to have? Are you hoping that what you're doing is modeling something that could be more broadly adopted by the market in its totality? What is the bigger picture North Star, I guess, for Congruence in terms of your impact at a systems level?
Yeah, well, let's see. I'll start with answering the question whether or not we charge for advice first, which is no, we don't. My partner, Michaela, used to head Accenture's North American sustainability consulting practice. She always jokes it's nice that she doesn't have to worry about selling anyone anything anymore. She gets to offer her advice for free. And, we and our investors only benefit if the companies take our advice, do a good job implementing it, and it results in change that creates shareholder value. And I think management teams really appreciate that alignment, right? And that we're there to help and help them achieve their goals. But then, answering this question about systematic change, I think public markets are the last great impact investing frontier, and they also represent the biggest opportunity. It's the most economic activity, and as it relates to this panel, the most emissions. And I want to stress that I think our work is highly complementary to private market impact investing. It's not a question of public or private. It's about the synergies between public and private. And if you believe in the value proposition of the companies you're backing in a climate tech fund, why not also make money as their customers implement that technology? I think many of the other impact or sustainability aligned public market strategies have failed to catch on because they ask investors or companies to sacrifice returns or profitability in the furtherance of a sustainability goal. And we think that for solutions to scale and result in systematic change, they have to work in the context of capitalism and truly be win-win-win for all parties involved. So when we think about that opportunity for systematic change, I'd like to circle back to that example I just outlined about implementing carbon injection technology into precast concrete product manufacturing. There are the very obvious first order impacts of that change at our portfolio company, but then there are second order impacts on the competitors and the customer base, and then there are third order impacts on the investor community. So let's run through those. So on the first order impacts, that change reduces the carbon intensity of their products, it reduces their cost base, it grows revenue through monetization of the carbon credits, and it helps them market to sustainability focused customers. Then on the second order impacts, there may be competitors to the company that take note and start implementing the technology themselves. And customers may ask for similar products in markets where our company doesn't operate. And think about the third order impacts. The change should result in the company being more profitable, which should result in a higher share price. And investors will take note, make a stronger association between sustainability and value creation. They could ask other management teams at other companies they own that consume cement whether or not they should be implementing the technology too. And those are just the impacts of one impact initiative at one of our portfolio companies. But think through the math. We typically identify 10 to 15 impact initiatives at each of our portfolio companies. We have 16 portfolio companies right now. Each of those companies typically have 3 to 4 large competitors and hundreds of customers. And those companies have hundreds or thousands of investors. So we think that math is really powerful and gives us an opportunity to create outsized change relative to our asset base through those ripple effects. And I think climate change is the single biggest challenge humanity faces in our lifetimes. And everyone here has a role to play in meeting that challenge. Congruence is looking to advance the effort in our own way, in our corner of the investing universe. And we'd appreciate anyone who can help us in our mission. I also want to say, we think systematic change really starts small and scales, and we're doing our part to get that snowball rolling down the hill.
Well, really appreciate those comments, Brett, and a bit of a call to action there. I do feel like this conversation is at the vanguard a little bit, and probably we need to keep having it constantly in the next few years. But it's an exciting opportunity. So turning to some of the questions that have come in from our viewers, and thank you for sharing them. Jorge, I think you made some nice comments about the need to just continue to keep our eyes on the prize vis-a-vis policy making, and making sure public policy is creating the right incentives to grow this market. But politics does also come into it, and the environment that we're currently in, and the pushback on ESG in recent years, I think, has created some headwinds. But would love to hear from you all. I mean, is that impacting the work you're doing? Are you still seeing demand from allocators for public markets product focused on climate? If you can just give us a little bit of a lay of the land and what impact the political environment has had, would welcome that commentary. I don't know who wants to get us started. Jorge?
Well, let me take that one, or at least start it, because it's like a complicated question. I think the best reference that we have there is if we ask ourselves why Europe and the demand for climate and sustainability from investors, is kind of growing and kind of like even like rampant there, whereas here in the US over the last 3 years, how we have discussed, is kind of a little bit like dampened. So I think at the end of the day, you have to go back to legislation, right? You have to get to that regulatory kind of framework that Europe has adopted, that we, for one reason or another, are like a little bit of a stalemate at the moment. I am optimistic, like Brett said, this is the biggest challenge that we are facing as humanity, climate change. So eventually things will come into place. However, at the end of the day, we're all in the business. Everybody was in the business of making money. Our investors are in the business of making money. And there's no doubt that everything related to climate transition has a bottom line effect. And I think that's where exactly things are going to just open the door. Because, like Brett said it in some of his comments at the beginning, it's pure capitalism at its best. And once the work that Heather is doing as Scope 4, like really kind of the issuers realize that for their survivability to survive, they're going to have to implement these measures. That's where investors will take kind of pay attention to it and invest in that.
Got it. Would anyone else like to add to what Jorge said about that? Okay. Let's go to the next question, and I think it is a little bit of a tricky one. Heather, I'll come to you on this question, because then you can do what they do in presidential debates and answer the last one instead. But we have some questions again about the kind of mechanism of impact. Let's describe it, the mechanism of impact in public markets, whether it's divestment, whether it's engagement, whether it is fueling stock price growth to lower cost of capital, attract talent, and disseminate technology, as you mentioned. what's your sense of the levers that can be pulled in public markets that result most efficiently and optimally in the impact outcome that we're pursuing? And Tetiana, I'd love to ask you the same question after Heather's pull to move and going back to the last question about the ESG dynamics. Heather?
Yeah, sure, I can answer that. I mean, I do think that divestment can be a good strategy. I also think that if you're going to divest away from oil and gas or from anything that's creating emissions or causing emissions, that you should also invest in the solution, right? That's really important. So we talked about the trillions of dollars that need to be allocated to solve this crisis. Just to give you a sense for the velocity of commitments that have been made just over the course of the last 5 years. There are now 140 countries and over 5,000 public companies that have committed to net zero. Okay, so that's a really big deal. And everyone is working towards decarbonizing their company and their country. But what we need is supply or companies that are enabling these entities to go about doing that, right? So that's what we're doing at Scope 4 is we're investing in companies that we view as the supply to the demand to decarbonize. And so that to me is a great place to put your divested capital. Because at the end of the day, we really have 8 billion people on this planet, an increase in demand in energy that's not going anywhere. AI is going to make it worse. We have demand for data centers, increase in demand for water, increase in demand for food. And so the exercise towards a more sustainable way of addressing these finite resources that we have is to invest in these public companies that are solving for some of these things. Just in terms of impact, I know that's such a tough question, and we've thought deeply about it, and I'll tell you how we define our impact because we're focused really specifically on climate change. Climate change to me is an umbrella word, and underneath that, if you're addressing climate change, you're also addressing a variety of different things, including water scarcity, our food issue, plastic waste, so on and so forth. So to me, addressing climate change also provides co-benefits. But what you can do is look at what's called emission reduction potential. And so if you just think about, okay, how do I allocate my capital to have the most impact? I would suggest that you check out a resource that we use that really inspired our inception called Project Drawdown. And we also use a tool called Crane Tool, CRANE tool. And they've identified solutions to say, okay, if in the next 10 years, we replace oil and gas with, let's just say, onshore wind. We replace it by 75%. This is the emission reduction potential of what that could look like. So you're actually reducing this many tons of carbon from the atmosphere if you replace these higher emitting technologies with lower emitting technologies. And while that's really hard to do on a company by company basis, because you really need to know what your total addressable market is, and that's pretty challenging to calculate. What you can do is say, you know what, I know that onshore wind has a higher emission reduction potential than, let's just say, like biomass, right? And I know that refrigerants and addressing refrigerants or addressing food waste has a higher emission reduction potential than other technologies. And so maybe I want to allocate my capital towards that because I care the most about that level of impact.
Got it.
And so that's what we've done.
Got it. Thanks, Heather. And sounds like the tailwinds are definitely much stronger than any headwinds that we might be experiencing politically. Tetiana, do you want to add on to what Heather shared?
Sure. And again, from an allocator or hedge fund specifically allocator's perspective, right? So empirically, having studied the investment universes, of course, one can punish sustainability or climate specifically laggards by going short. However, we are inclined to think that it's just one of the tools for us, and a more balanced approach and a more arguably resource intensive approach by engaging with the managers could be a more effective way of approaching an investor's climate transition strategy. It's certainly not as straightforward. You need to engage, you need to have that discussion, understand the nature of transitional underlying exposures, share best practices with managers, what their peers in the space doing, right? So that brings me back to my point about peer grouping and accurate benchmarking, et cetera. Your kind of best practice sharing has to be relevant for the manager's strategy or sector focus. But I think all of that expands our toolkit rather than just purely divesting from companies that currently happen to be laggards.
Got it. Got it. Thanks, Tatiana. With limited time left, I'd love to do a quick lightning round to end our conversation, and thank you all so much for being with us. And we'll go in the same order that you were introduced. And I'd love to give you the opportunity to bust one myth that you think is out there about the opportunity to generate impact, climate impact in public markets. And Heather, I'm going to begin with you.
Okay, I'm just gonna add a statistic to what we were talking about before, that FTSE Russell has put out as of Q1 2024 about the market cap and the green economy, that it's currently reached $7.2 trillion. So it currently represents 9% of the total equity market. And then based on their projections, that market cap is poised to increase by 20% just by 2030 alone. So we talked a little bit about impact, and now that gives you a reflection of what we think the opportunity is. Awesome.
Thank you, Heather. Jorge?
I would say 2 degrees centigrade, right? We focus a lot on that, and environmentalists focus a lot like that. I think it's all about what we're doing here in this webinar and this conference right now is about scaling, and stop focusing too much about the number and focus about everything that everybody's doing, all these initiatives, and really making an impact. The number will come automatically.
Right. Thank you, Jorge. Brett?
Yeah, I think the biggest myth is that to be a more sustainable business, you have to be less profitable, and your investors need to accept lower returns. Nothing could be further from the truth. And I think in the example I gave earlier, it's pretty obvious the company's saving money and reducing emissions. We're not giving anything up. We're creating value using these sustainability principles. And I think ultimately, what I'm describing will manifest itself, in our returns and our track record over time. And I think nothing gets attention on Wall Street like great risk-adjusted returns.
Awesome. Well, thank you, Brett. And from the report I saw that I think you emailed around last week, it does seem the returns are in a pretty good shape. So congratulations on that. Tatiana, the final word for you.
Thank you, Ben. Well, given a certain image of hedge funds that exists in the media, and I can't tell you how many times people have asked me if I've seen billions, I think the biggest myth is that hedge funds and sustainability and potential for positive impact are the exact opposites. And I hope, as we've seen during the panel, it's not quite true, or at least not always. Hedge funds can be a part of a climate-oriented portfolio.
Right. Well, thanks, Tatiana. Brett, Jorge, Heather, really appreciate you all joining us. A really important conversation. Again, I think we need to continue having these conversations. Thank you to our viewers for joining us. And this conversation will be online soon. We appreciate you being part of the Compass series and look forward to seeing you next time. All the best. Thanks so much.
Thank you.
Thank you.